Shri Ganeshaya Namaha.
The present lesson is on accounting and its introduction. The contents of the lesson are business and relevance in accounting, objectives of accounting, definition of accounting, stakeholders of accounting, and terminology associated with accounting. Let us start with business and accounting relevance. Business may be in any form. It may be a sole trader concern, invested, operated, owned by businessmen, a single person, or a partnership where associating another person to be as a partner, or and company where more number of investors invest in small amounts. Whatever it may be the business form, the accounts, whatever it may be the business form, the accounts are which helps to understand the business. If one could understand the accounting, the nature and its trends, results, everything can be understood. Now, so accounts has its own relevance in business. Next, objectives of accounting. While coming to the objective, there are basic two objectives associated with accounting are results interpretation and financial status of the business. To know the financial status of the business, the accounts gives an idea. Let us have a discussion on these two. If accounts are prepared for a particular period, during the period, whatever the transactions involved by the business are all finally summarized and then recorded. It gives a result. It may be a profit or loss. That is the basic objective. While coming to the status of the business, along with the interpretation of the result on a particular date ending, the financial status of the business can be known with the help of accounting. Then, definition of accounting. A number of definitions have been given by various eminent personalities, but most popular is given by American Institute of Certified Public Accountants, AICPA. It has given an elaborative and a clear definition about the accounting. Accordingly, accounting is art of recording, classifying, summarizing these in a significant manner in terms of money, transactions, events which are in part at least of a financial character and interpreting the results thereof. To analyze this definition, the ultimate objectives of the accounting ultimate object of accounting is result interpretation. To have such a result, whatever the events, either in the form of cash or a transaction or an event are considered. Whatever the element, there is an element required. It may be in the form of cash or a transaction or an event. But it should have one feature that is called financial character. In case any element considered for accounting should have the financial character, will automatically be taken into account. So if such a basic feature is fulfilled, those elements called cash, transaction, event are first of all classified, summarized, classified, summarized and recorded. So, here, what are the transactions are considered, elements are considered. First of all, they are classified into one group. One such group of transactions are summarized into one set. Those sets are recorded. So, while doing this process, the objective is so fulfilled. So, in simple to say, the transactions should have financial character, and all such transactions are basically classified and summarized and recorded. Then ultimately the results of the business are interpreted. This is the process of accounting. Now, the parties involved accounting are called accounting stakeholders. The stakeholders of accounting are owners, creditors, debtors, public, employees, government. Let us have an idea on these. Owners naturally they invest in business. They have their inquisitiveness. They want to know how their investment is, whether it is moving positive or negative. So accounting that serves the purpose. While coming to the creditor, one who I have provided credit to the business. Naturally, the person may have an interest how the business goes on. Then, debtor. Debtor is a person, one who purchased the goods from the business, whose business he is dependent on the supplier's business. So also he is also dependent on the accounting. And then public. Public should also know where they are purchasing genuine product and at a genuine price. So public purpose is also be served there. Then employees. Employees are the owners. Employees are also a part of owners in certain businesses. So naturally employees expect some part in profit. So they also get information through accounting. So that purpose is also be served. Likewise government. In the name of government, certain regulating authorities, they do also dependent on the accounts results, financial statements. In this manner, accounts helps a lot and gives an idea about the business. Now, having understood all these, let us try to make an idea about the terminology. The terminology which gives what's called a meaning, an understanding channel to the business, right? And as well as accounting. So let us discuss the terminology of the accounting. The first one is capital. Capital is the investment made by the owner. Capital is investment made by the owner. It may be in the form of cash or any kind. Sometimes the owner invests in cash. Some other times he may invest in the form of an asset. So whatever may be the form of investment made by the owner is known as capital. Then drawings. Drawings is the value of the goods or cash taken away by the owner from the business for his personal purpose. The purpose of utilizing the business cash and the goods should be determined or confirmed by the businessman itself. Okay, it is at the discretion. The next one is the good. Good is an item purchased for business of a main activity. If a production-oriented unit purchases raw material for the purpose of producing something, whereas a distribution unit which purchases finished goods for the purpose of a sale. So main activity is either production or sale. For that purpose, whatever the items the business purchases, it is a good. Next one is the asset. Asset is an item which supports the business, like land and buildings, plant and machinery, vehicles, and so on. So a fixed asset, once it's created, it will have its support to the business till to its life. Now, next one is the liability. Liability is the amount owes to someone. It may be because of raw material supplied to the business or loan provided to the business. The next one is expenses. This is also known as, sometimes termed as, expenditure. Expenditure may amount spent for the purpose, for any purpose. It is of two types. One is capital expenditure, the other one is revenue expenditure. Capital expenditure is an amount spent for creation of the assets. Normally it occurred in the case of assets creation. Normally it met at once only. Whereas revenue expenditure is the expenditure which is recurrent, occurred repeatedly. Say salaries, rent paid, and then taxes paid, traveling expenditure. These are repeatedly occurred during a period. Then next one, revenue. It is also known as income. It is also known as income, or another word, receipt. So it is of two types. One is a capital receipt, another one is revenue receipt. Capital receipt occurs at once only. Often it occurs. But revenue receipts regularly occur. Say in the case of sales. Sales is a revenue receipt or revenue receipt. And capital receipts are whenever goods, fixed assets are sold, it occurred only oftenly it is done, so that revenue receipt is then repeatedly occurred, whereas capital receipt occurred at once only or oftenly. The next one is the creditor. One who supplied goods to the business is a creditor. Another term is the credit supplier. It indicates the amount owes to that person. It is the amount payable to someone. It is a liability. Whereas, as what we call debtor. Debtor is a person who purchased the goods from the business, or from business point of view or business angle. The debtor is a person to whom the goods are sold. To whom the goods are sold. The debtor indicates the amount receivable from that particular person. It is an asset. Then transaction. A transaction is an element involved in a business process. It may be an expenditure, it may be an asset purchase, acquisition, it may be investment made by the owner. Anyhow, it is of two categories. One is cash transaction, the other one is credit transaction. Cash transaction involves cash transfer in that involvement in the business, whereas a credit transaction, such a cash transaction doesn't exist. Then a discount. Discount is the concession allowed by the seller to the purchaser of the goods. Again, it is two types. One is trade discount, another one is cash discount. Trade discount is the concession allowed by the wholesaler to the retailer against the MRP, maximum retail price or market price. Net of the trade discount is recorded in accounts. So trade discount doesn't considered in account, it won't come into account. On the other hand, cash discount. Cash discount is exist in the case of cash payment made by the purchaser of the goods to the seller. Normally, whenever the goods sold by a person to another one, the credit allowed by the seller is intimated to the purchaser. If in case the purchaser wants to extend the credit period with the permission of the seller, he prepares a document, and that document that is called bill. Later we will have a discussion. So the discount at the time of credit extension, before the due date, in case the payment is made by the purchaser to the seller, the seller may allow some concession out of the payment outstanding due. That amount is called cash discount. So cash discount is the concession allowed by the receiver of the cash against an outstanding due from someone. Then journal. Journal is a first entry book where all the events or the transactions are recorded in a chronological order. Mostly the date of transaction is in a chronological order basis. Then account. Account is a format where one type of transactions are recorded. Capital account, cash account, stock account, and debtors account, and so on. The transactions related to particular account, such account are only recorded. Against the on account and its features, we will have a later discussion. Then the ledger. Ledger is an element, is a book consists of. Ledger is an element where book consists of various accounts. If different accounts are being maintained in one book, called as a ledger. Next to voucher. Voucher is what's called an evidence of receipt to pay goods supplied. See, in the case of goods supplied, a voucher is prepared if cash is paid. Besides that, a statement is prepared consists of various items of goods sold. That is called invoice. Okay. Then stock. Stock is the value of the items we are held with the business on a particular day. It may be in the form of raw material. It may be form of open stock, raw material, finished goods or semi-finished goods. The stock is valued on different dates. If such valuation is made in the beginning of the accounting period, is called opening stock. If the stock is valued on the closing date of an accounting period, is called closing stock. Then accounting period. Accounting period, the period considered for accounting. It may be normally 12 months is the period considered. It may be January to December, June to May, and so on. Sometimes business, for accounting treatment, business results are being considered and evaluated. Those are maybe a 3 months, quarterly accounting period, half yearly. Bill exists in the case of goods sold on credit, where the purchaser wants to credit period normal beyond the normal credit period allowed by the seller. Say sometimes the seller normally seller gives 1 month credit. If the purchaser wants to extend the credit period, he prepares a format, and that is a format of called bill. Bill may be of two types. One is bills receivable, another is bills payable. Bills receivable indicates the amount receivable from various customers who wants to extend their credit period allowed by the businessman. Whereas bills payable, it indicates the amounts bills prepared by the particular businessman against the payments to be made towards the purchases made where accession credit is allowed by the particular supplier of the material. Bills receivable in asset, bills payable in liability. And then profit and loss account. The profit and loss account is the difference between income and expenditure. In that sense only, such terms shall be used. If the income is more than the expenditure, it is profit. On the other hand, it is loss. With this, the first lesson is completed. For further details, can refer to the blog.